Ever feel like the crypto market is just one giant, confusing roller coaster? One day, everyone's screaming Dogecoin to the moon. And the next, some new Memecoin you've never heard of is crashing to zero. It's a world of extreme highs and devastating lows. You see headlines about people becoming millionaires overnight, and then you see stories of others losing their life, savings. It's chaotic, right? But what if I told you that beneath all that noise, a massive, powerful shift is happening? A change that's making the crypto world more stable, more accessible, and potentially more important to your financial future than ever before. We're talking about the quiet giant, Bitcoin, and a game-changing financial tool. The ETFs stick with me, because by the end of this video, you'll have a much clearer picture of what's really going on and how you can navigate this space without getting burned. We're going to cut through the hype and get to the heart of what matters. To really understand where we are now, we have to talk about the wild side of crypto. Memecoins remember the craze. It felt like every week there was a new coin with a funny dog or a cat on it, promising insane returns. People jumped in, driven by pure hype on social media. The appeal was simple: low entry price and the dream of a 1000x return. It felt like a lottery ticket that could actually pay off. We saw coins with no purpose, no technology, just a catchy name and a strong community of online cheerleaders skyrocket in value. It was thrilling, and for a small few, incredibly profitable. But what goes up that fast often comes down even faster. Lately, we've seen a brutal reality check. A string of high-profile Memecoins has completely collapsed. One week, they're all over your social media feed. The next, they've flatlined, with their value plummeting over 99%. So, why does this happen? Well, it's a perfect storm of problems. First, most of these coins have zero real-world utility. They don't do anything. Their entire value is based on pure speculation and the hope that someone else will buy it from you for a higher price. This is what finance folks call the greater fool theory. Second, the market is often manipulated. A few large holders, known as whales, can control a huge percentage of the coin's supply. They can pump up the price by buying a lot, create a frenzy, and then dump all their coins on the unsuspecting newcomers, causing the price to crash instantly. And sometimes, it's even more sinister. We see exit scams, or rug pulls, where the anonymous creators of the coins simply disappear with all the investors' money. The lesson here is brutal but essential. Herd mentality and the fear of missing out, or FOMO, are incredibly dangerous in investing. Chasing hype without understanding the underlying asset is a recipe for disaster. It's like gambling, not investing. The Memecoin meltdown serves as a stark reminder that in the world of crypto, not all that glitters is gold. Now, let's shift gears and talk about the complete opposite end of the spectrum. Bitcoin? While Memecoins are like flashy, unreliable sports cars, Bitcoin is more like a steady, powerful freight train. It's built on entirely different principles. Let's break down why it's in a class of its own. First, Bitcoin has solid fundamentals. It was the first, and it's built on a revolutionary technology called the blockchain, which allows for secure, decentralized transactions without needing a bank or a middleman. It is a real-world use case as a store of value, often called digital gold, and as a censorship-resistant way to transfer value across the globe. Unlike Memecoins, which can be created out of thin air in unlimited quantities, Bitcoin is fundamentally scarce. There will only ever be 21 million Bitcoin in existence. That's it. This programmed scarcity is one of the main drivers of its value. You can't just print more Bitcoin when you feel like it, which is a stark contrast to traditional currencies. And crucially, it's decentralized. There's no CEO of Bitcoin, no central company that can shut it down or manipulate its rules. It's run by a global network of computers, making it incredibly resilient. Lately, Bitcoin's performance has reflected this strength. While the broader market has been volatile, Bitcoin has shown bullish trends. We're seeing technical indicators that many analysts interpret as signs of a coming bull run. A huge part of this positive outlook is the anticipation around the Bitcoin halving. This is an event that happens roughly every 4 years, where the reward for mining new Bitcoin is cut in half. This reduces the rate at which new Bitcoin are created, effectively increasing its scarcity. Historically, The periods following a halving have been associated with significant price increases. On top of that, we have macroeconomic factors at play. With high inflation in many parts of the world, people and even institutions are looking for assets that can hold their value. So-called inflation hedges. Bitcoin, with its fixed supply, is increasingly seen as a viable option. We're seeing more and more large companies and investment funds adding Bitcoin to their balance sheets. This growing institutional adoption signals a major shift. They aren't chasing hype. They're making calculated, long-term investments based on Bitcoin's fundamental properties. This is a world away from the Memecoin casino. It's a sign of a maturing asset class. So, what's the bridge connecting this serious institutional interest with the everyday investor? A huge part of the answer lies in 3 simple letters. ETF. Specifically, Spot Bitcoin ETF. This might sound like financial jargon, but it's one of the most important developments in crypto history, and it's crucial to understand. So, what exactly is a Spot Bitcoin ETF? An ETF, or exchange-traded fund, is an investment product that trades on a traditional stock exchange, like the New York Stock Exchange. A Spot Bitcoin ETF holds actual Bitcoin as its underlying asset. When you buy a share of this ETF, you're essentially buying a share of the Bitcoin that the fund holds. How does it work? Financial giants like BlackRock or Fidelity buy massive amounts of real Bitcoin and store it securely. They then issue shares that represent ownership of that Bitcoin. You, as an investor, can then buy and sell these shares through your regular brokerage account, just like you would with shares of Apple or Tesla. You don't need to worry about setting up a crypto wallet, managing private keys, or dealing with crypto exchanges. It removes all the technical hurdles. This has been a total game changer for institutional adoption and mainstream accessibility. Large pension funds, investment advisors, and hedge funds that were previously hesitant or unable to hold crypto directly can now easily get exposure to Bitcoin through a regulated, familiar product. This has unlocked trillions of dollars in potential investment capital. For the average person, it means you can invest in Bitcoin right alongside your stocks and bonds, all in one place. This makes the market more liquid, meaning it's easier to buy and sell without causing huge price swings. It also improves price discovery, as the ETF price is directly tied to the real-time price of Bitcoin, bringing more transparency to the market. But of course, it's not without risks. While an ETF simplifies access, the price of your shares will still be as volatile as Bitcoin itself. However, the benefits in terms of legitimacy, security, and ease of access are undeniable. The ETFs are a massive signal that Bitcoin is no longer a fringe asset. It's a serious player on the global financial stage. So, let's tie this all together. We've seen 2 very different sides of the crypto world. On one side, you have the chaotic, speculative frenzy of memecoins, driven by hype and often leading to painful losses. On the other, you have Bitcoin, a foundational asset with solid principles of scarcity and decentralization, which is steadily gaining mainstream acceptance. The key takeaway is the importance of differentiating between purely speculative assets and those with real, underlying value. The Memecoin collapses teach us the dangers of FOMO, while Bitcoin's resilience and the arrival of ETFs show us that the market is maturing. It's moving away from the Wild West and toward a more established, integrated part of the financial system. This doesn't mean you should run out and put all your money into Bitcoin. As with any investment, the golden rules still apply. Do your own research, understand what you're buying, and never invest more than you're willing to lose. Adopting a long-term mindset is crucial. Instead of trying to get rich quick, think about how these assets might fit into a diversified portfolio over the next 5 or 10 years. The crypto landscape is still evolving, but the direction is becoming clearer. The noise is fading, and the substance is starting to shine through. Now, I'm really curious to hear what you think. Is the ETF a game changer? Are memecoins just a bit of fun? Or are they dangerous for the industry's reputation? What are your thoughts on the future of crypto? Let me know in the comments below. I read every single one. And if you found this video helpful and want to keep cutting through the crypto noise, make sure to hit that subscribe button. Thanks for watching, and I'll see you in the next one.